U.S. bonds are like loans you make to the government. When you buy a bond, you're giving the government money. In return, the government promises to pay you back with interest. This makes bonds a type of investment. U.S. bonds are important because they help fund the government. They help pay for things like roads, schools, and the military. Bonds are generally considered a safe investment, especially U.S. bonds. Bonds have different maturities. Maturity means how long it takes to get your money back. You can choose a bond that fits your investment goals. For example, a 10-year bond will mature in 10 years. When the bond matures, you get your original investment back, plus the interest earned. You can buy bonds from the government or through a brokerage account. A brokerage account is like a bank account for investments. There are different ways to buy bonds. You can buy them at an auction or in the secondary market. The secondary market is where investors buy and sell bonds from each other. When you buy a bond, you need to decide how much you want to invest. Bond prices fluctuate based on interest rates. If interest rates go up, bond prices usually go down. If you sell a bond before maturity, you might not get back your initial investment. This is because bond prices fluctuate in the secondary market. One of the main benefits of bonds is their regular income. Bonds pay interest regularly, usually twice a year. This is called a coupon payment. These payments can provide a steady stream of income for investors. Bonds can be a good addition to a diversified portfolio. Diversification means not putting all your eggs in one basket. By investing in both stocks and bonds, you can potentially reduce your overall investment risk. Bonds are generally considered less risky than stocks. This is because bond prices tend to fluctuate less than stock prices. Bonds can provide stability to your portfolio, especially during market downturns. When stock prices are falling, bond prices may hold their value or even increase. Section 4. Potential risks to consider. While generally considered safe, bonds do have risks. One risk is interest rate risk. If interest rates rise, the value of your bond may go down. This is because investors can buy new bonds with higher interest rates. Another risk is inflation risk. Inflation is when prices for goods and services increase over time. If inflation is higher than your bond's interest rate, your investment may lose purchasing power. Credit risk is another factor to consider, especially with corporate bonds. This refers to the possibility that the bond issuer may default on their payments. U.S. Treasury bonds are considered to have very low credit risk. It's important to understand the risks before investing in bonds. Diversifying your bond holdings can help mitigate some of these risks. Section 5. Practical tips for new investors. Start small and gradually increase your investment as you learn. Consider investing in U.S. Treasury bonds, as they are considered very safe. Don't be afraid to ask for help from a financial advisor. A financial advisor can help you create a bond investment plan that meets your individual needs. Research different types of bonds and choose those that align with your financial goals. Pay attention to interest rates and how they might affect bond prices. Remember that bond investing is a long-term strategy. Be patient and don't panic sell if the market fluctuates. Section 6. Expanding your bond knowledge. There are many resources available to help you learn more about bond trading. The U.S. Treasury Department website provides a wealth of information on Treasury bonds. Financial websites like Yahoo Finance and Bloomberg offer bond quotes, news, and educational resources. Consider reading books or taking online courses on bond investing. Look for reputable sources that provide unbiased information. Stay informed about market trends and economic indicators that can impact bond prices. Understanding these factors can help you make more informed investment decisions.